This case study examines the accusations of accounting fraud made by Harry Markopolos, a former financial analyst, against General Electric. Markopolos accused GE of using aggressive accounting methods to inflate its earnings and conceal its true financial condition. He claimed that GE was involved in practices like off-balance sheet financing, manipulating reserves, and aggressive revenue recognition. The case study emphasizes the clash between Markopolos, who aimed to reveal GE's alleged financial misconduct, and GE, which strongly rejected the claims and defended its accounting methods. It also highlights the significance of corporate governance, regulatory supervision, and the need for ethical financial reporting to preserve investor trust and uphold the integrity of financial markets.
Evaluation of the case. The case study centers around the allegations made by Harry Markopolos regarding General Electric's GE accounting practices, particularly concerning its long-term care or LTC insurance business. Markopolos claims that GE committed accounting fraud by under-provisioning its statutory LTC reserves, which, he argues, misrepresents the company's financial health. In contrast, GE's CEO Larry Culp rejects these allegations, asserting that the company's accounting practices are sound and compliant with regulatory standards. This section will explore the key risks associated with GE's LTC business, including the potential for increased claims as policyholders age, and the challenges of accurately estimating future liabilities. Additionally, it will highlight opportunities for GE, such as potential premium increases and adjustment to benefits that could stabilize the financial outlook of its LTC segment.
Harry Markopolos, known for exposing the Madoff Ponzi scheme, has accused General Electric of accounting fraud, claiming the company overstated its earnings and hid up to $38 billion in liabilities. However, GE CEO Larry Culp rejects these allegations, asserting that the company follows proper accounting standards and has undergone independent audits. While Markopolos' expertise and concerns about GE's financial practices, such as discrepancies in reported earnings and liabilities, raise valid points, GE maintains its commitment to transparency and restructuring under Culp's leadership. Ultimately, the truth requires independent investigation. Although it may seem too early to find a definitive answer, although it may seem clear that GE's financial statements are complex and not understandable to the public, we should still be digging deeper about what truly is the cause of these nuances. And so we have to provide further investigation to acquire evidence and more information.
Question number 2. Identify the key risks and opportunities of General Electric's LTC business. The key risks are: first, underfunded reserves. General Electric face significant challenges in maintaining adequate reserves for its LTC policies. Markopolos highlighted a need for $18.5 billion in immediate cash to bolster loss reserves, indicating that the company had not accurately accounted for its liabilities. The second risk is regulatory challenges. The LTC business operates under strict regulatory scrutiny, and raising premiums requires approval from state regulators. And this can be difficult as regulators may reject requests even when justified, leading to financial strain on the business. Third is market perception and credibility. The allegations of accounting fraud and the historical context of GE's financial reporting have damaged its credibility. This could lead to a lack of trust from investors and policyholders, impacting the company's ability to operate effectively in the LTC market. The fourth risk is complex financial reporting. General Electric's financial reporting in the LTC sector has been described as particularly complex. which can obscure the true financial health of the business. This complexity can lead to misinterpretations and further scrutiny from analysts and regulators. And the last risk is aging population. As the population ages, the demand for LTC services is expected to increase. However, if General Electric is unable to manage its reserves effectively, it may struggle to meet the growing demand for these services. And the key opportunities are, first, the market demand. The aging population presents a significant opportunity for growth in the LTC market. If General Electric can stabilize its financial position and improve its reserves management, it would capitalize on the increasing demand for LTC services. Second is new management and strategy. The introduction of a new management team with deep industry experience could lead to improved operational efficiencies and better risk management practices within the LTC business. The third is potential for regulatory changes. If regulatory environments shifts to allow for easier premium adjustments or other favorable conditions, General Electric could enhance its profitability in the LTC sector. The fourth opportunity is reinsurance opportunities. General Electric's involvement in reinsurance for LTC policies could provide additional revenue streams if managed effectively. This could also mitigate some risks associated with direct insurance underwriting. And the last opportunity is improved financial practices. By addressing the concerns raised in the Markopolos report and enhancing transparency in its financial reporting, General Electric could rebuild trust with investors and policyholders, potentially leading to a stronger market position.
Question number 3. Perform the annual journal entries for GE's LTC policies using the information in Exhibit 10. How would GE account for the following changes at the beginning of year 2 when A. GE expects that the expenses increases to 6,000 in year 5 and B. GE expects that the gross premiums decrease to 4,000 in year 5. So here are our expected cash flows in the given in Exhibit 10. So assuming the following expected cash flows for the LTC insurance policy, in year 1 we had expected expenses of $3,000 and $5,000 expected gross incomes. In year 2, 4,000 expected expenses and 5,000 expected gross premiums. In year 3, 4,500 expected expenses and 5,000 expected gross premiums. In year 4, 4,500 expected expenses and 5,000 expected gross premiums. In year 5, 4,500 expected expenses and 5,000 expected gross premiums. Now, before we go on with our journal entries, we must first get through with the calculations and the supporting computations. So step 1, present value calculations. So the total PV of expected expenses, which is 3,000 in year 1 plus 4,000 in year 2 plus 4,500 in year 3 plus 4,500 in year 4 and 4,000 in year 5 is equal to 20,500. While the total PV of expected gross premiums is equal to 25,000 since the gross premiums are 5,000 per year. So next we calculate the net premium ratio. The net premium ratio is equal to the total PV of expected gross premiums divided by total PV of expected expenses. So that will be 25,000 divided by 20,500, which is 0.82 or 82%. Step 3. Calculate net premiums. Net premiums for each year can be calculated by multiplying the expected gross premium by the net premium ratio divided by the number of years. So, the net premium ratio is 0.82 or 82%. So, our expected gross premiums is $5,000 times the net premium ratio, which is 0.82, and we have the net premiums of $4,100. Step 4. Calculating the reserve liability. The reserve liability for each year is calculated as follows. Year 1, reserve liability is equal to the PV of expected expenses from year 2 to year 5 less than the total of the PV of expected net premiums from year 2 to year 5. So that will be 17,500 minus 16,400, which is equal to a reserve liability of 1,100. Year 2, reserve liability of year 2 is equal to the total PV of expected expenses in year 3 to year 5, less than the total PV of expected net premiums from year 3 to year 5. So that will be 13,500 minus 12,300, which gives us a reserve liability of 1,200. This 1,200 is $100 more than the year 1 reserve liability. Now in year 3, the reserve liability is equal to the total PV of expected expenses from year 4 to 5, less than the total PV of expected net premiums from year 4 to 5. This gives us 9,000 minus 8,200 and a reserve liability of $800. This is a decrease from the year 2 reserve liability of $1,200. So in year 4, the reserve liability for year 4 is equal to the total PV of expected expenses of year 5, less than the total PV of expected net premiums in year 5, which is 4,500 minus 4,100, which gives us a reserve liability of $400. Again, this is a reduction of the reserve liability from the $800 reserve liability in year 3. Now in year 5, we have the reserve liability in 0 as there are no future expenses or premiums. Now, our journal entries. In year 1, we debit cash $5,000, which is the expected gross premiums, and also we credit the premium income $5,000. Now, our benefits expense is equal to the reserve liability plus expected expenses. So that is 3,000 plus 1,100, so our benefits expense is 4,100. Now, we credit cash 3,000 because it was the expected expenses, and we also credit reserve liability 1,100. In year 2, our journal entries are cash debit $5,000, which is the expected gross premiums, and benefit expense of $4,100. This is the total of the expected expenses, $4,000, and an increase in reserve liability, which is equal to $100. Then we credit premium income $5,000, which was from the expected gross premiums, and we credit cash $4,000, which was the expected expenses, and we also credit the increase in reserve liability $100. In year 3, our journal entries are debit cash $5,000, which was what we received from the expected gross premiums. Then we debit benefits expense $4,500, which is equal to the benefits paid. Now we have debit reserve liability $400. This is because in year 3, our reserve liability decreased by $400. So we debit the reserve liability $400 in order for it to reflect its true balance. Then we credit premium income $5,000. We also credit cash $4,500 from the benefit expense that we actually paid. And also we credit the benefits expense $400. In year 4, we also have our debit cash $5,000 debit, and the benefits expense $4,500, what we actually paid, and the reduction in reserve liability by $400 is also recorded as a debit to the reserve liability. Then premium income $5,000, cash $4,500 as what we paid for the benefits expense, and benefit expense of $400. In year 5, our journal entries are debit cash $5,000, benefits expense $4,500 from what we actually paid, and another reduction to the reserve liability of $400. Our credits are premium income $5,000 from our expected gross premiums, cash $4,500 from our expected expenses, and benefits expense $400. Now, before we go on accounting for the changes and the journal entries for the changes, we must first go back again to the calculation of reserve liability because this will be beneficial to the computations later. So, calculations of reserve liability. First, expected cash flows. As what we did earlier, we computed the total PV of the expected expenses and expected gross premiums. Next is the net premium ratio. The ratio is calculated to determine the proportion of premiums that will be available after accounting for expected expenses. It is calculated as net premium ratio is equal to present value of the expected gross premiums divided by present value of expected expenses. Third, reserve liability calculation. The reserve liability for each year is calculated as the difference between the present value of expected future expenses and the present value of expected net premiums. The formula is reserve liability T is equal to PV of expected expenses from T plus 1 to T plus N less than the PV of expected net premiums from T plus 1 to T plus N. That gives the difference is our reserve liability. So, we have here a table because the situation in letter A asks us about what would be the accounted changes since if the expenses in year 5 is equal to $6,000. So we have here our table. In year 1, $3,000 expected expenses. In year 2, $4,000. In year 3, $4,500. In year 4, $4,500. And finally, in year 5, the changes, $6,000 expected expenses. That gives us a total of $22,000. So our total PV for expected expenses is $22,000. Now, the expected gross premiums are still in $5,000 per year, so that gives us a $25,000 expected gross premiums. And our net premiums are equal to the $22,000 divided by $25,000 times $25,000, which gives us a net premium of total of $22,500 divided by 5 years. That gives us each of $4,400 net premiums each year. So now we have our expected expenses, expected gross premiums, net premiums, and reserve liability from year 1 to year 5 in this table. Having $6,000 as our expected expenses in year 5 gives us an amount of $22,000 as the total PV of expected expenses from year 1 to year 5, while our expected gross premium stays at $25,000 and our net premium is also equal to $22,000. How did we arrive at our net premiums? First, we computed for the net premium ratio, which is the PV of the expected expenses divided by the PV of the expected gross premium. So that is $22,000 divided by $25,000. That is 0.88 or 88%. Now, 88% of the expected gross premiums each year is equal to $4,400. So now that we have our net premiums at $4,400 per year, we can now compute for our reserve liability. Now, our reserve liability is computed by, first in year 1, we can compute our reserve liability in year 1 by having the total of the expected expenses from year 2 to year 5 less than the total of the net premiums from year 2 to year 5. So that is 4,000 plus 4,500 plus 4,500 plus 6,000. We now have a total of 19,000 in the expected expenses, and that is less than 4,400 times 4, which gives us an equal of 1,400. So our reserve liability for year 1 is equal to 1,400. Next, in year 2, we must first get the total of the expected expenses from year 3 to year 5. That is 4,500 plus 4,500 plus 6,000 is equal to 15,000. Now, our total net premiums from year 3 to year 5 is equal to 4,400 times 3, which is 13,200. Now, 15,000 minus 13,200 is equal to 1,800. As we can see here, our reserve liability increased from 1,400 to 1,800. Now, for our reserve liability for year 3, we must first get the total of year 4 and year 5 expected expenses, which is 4,500 plus 6,000 equal to 10,500. Now, the total amount of our net premiums for year 4 and year 5 is also equal to 4,400 times 2, 8,800. So 10,500 minus 8,800 is equal to 1,700. That will be our reserve liability. And as we can see, our reserve liability decreased from 1,800 to 1,700, signifying a $100 decrease in reserve liability. Now for our year 4, we must get the expected expenses of year 5 less than the net premiums of year 5. So that is 6,000 minus 4,400. That is equal to 1,600. That will be our reserve liability for year 4. And as you can see again, our reserve liability decreased from 1,700 in year 3 to 1,600 in year 4. That amounts to $100 decrease in reserve liability. For our year 5, we now have zero reserve liability as there are no more given expected expenses and net premiums. Now we have our table for the situation B, which states that the expected gross premium for year 5 declines to $4,000. As you can see here in our table, our expected expenses from year 1 to 5 are 3,000, 4,000, 4,500, 4,500, and 4,500. While our expected gross premium stays the same in the amount of 5,000 from year 1 to year 4, but then it decreases to 4,000 in the year 5. To get our net premiums each year, first we need to get the net premium ratio, which is computed using the PV of the total expenses divided by the PV of expected gross premiums for year 1 to year 5. So our total of expected expenses is 20,500 divided by the expected gross premiums total, which is 24,000. So 20,500 divided by 24,000 is equal to 85.42%, which is our net premium ratio. So now that we have our net premium ratio, we can calculate for our net premiums by multiplying it to our expected gross premiums. So since our expected gross premiums are 5,000 in year 1 to 4 times 85.42%, we get the net premium of 4,270.83. That is from year 1 to year 4. Now in year 5, our expected gross premium is $4,000. Multiplied by 85.42%, the net premium ratio, we get the net premium of 3,416.67. And now that we have our expected expenses, expected gross premiums, and net premiums, we can now solve for our reserve liability. Our reserve liability in the year 1 is computed using the total expected expenses of year 2 to year 5 less than the total net premiums from year 2 to year 5. So our total expected expenses from year 2 to year 5 is $17,500 less than the net premiums of year 2 to year 5, which is 4,270.83 times 3 plus 3,416.67, which is equal to 16,229.16. We subtract the two values and then we get the amount of 1,270.84, which is our reserve liability for year 1. For year 2, we do the same. We add the total expenses of year 3 to year 5, which is equal to 13,500, and the net premiums from year 3 to year 5, which is equal to 11,958.33. We subtract 13,500 less than 11,958.33, so we get the reserve liability of 1,541.67. Comparing the reserve liability from year 1 to year 2, we can now observe that there has been an increase in reserve liability in the amount of 270.83. Now in year 3, to get our reserve liability in year 3, we add the expected expenses of year 4 and 5, which is 9,000, less than the net premiums of year 4 and year 5, which is 7,687.5. We subtract the two values and then we get 1,312.50, which is our reserve liability for year 3. Comparing the year 3 reserve liability from year 2, we can now observe that there has been a decrease in the reserve liability in the amount of 229.17. Moving forward, our reserve liability for year 4 is calculated by subtracting the expected expenses of year 5 less than the net premium of year 5. 4,500 minus 3,416.67 is equal to 1,083.33, which is our reserve liability for the year 4. Comparing our reserve liability for year 4 and year 3, we can now observe that there has been another reduction in our reserve liability in the amount of 229.17. Now, our reserve liability for year 5 is deduced to 0 as there are no other expected expenses and net premiums in the following years given. So in year 1, we debit cash $5,000, debit benefits expense 4,270.84, which is equal to our expected expenses plus reserve liability. Then we credit premium income $5,000, credit cash $3,000, and also credit the reserve liability 1,270.84. In year 2, we debit cash $5,000, debit 4,270.83 benefits expense, which is equal to the expected expenses that year plus the increase in our reserve liability that year. Then we credit premium income $5,000, credit cash $4,000, and then we credit the increase in reserve liability, which is in the amount of 270.83. In year 3, we debit cash $5,000, debit benefits expense $4,500, which is equal to the actual amount paid, actual expense paid. Then we also debit the reserve liability in the amount of 229.17, which is equal to the decrease of reserve liability from year 2 to year 3. Then we credit premium income $5,000. We also credit cash $4,500 and credit benefits expense $229.17. In year 4, we debit cash $5,000, debit benefits expense $4,500, which is still equal to the actual amount paid, and also reserve liability 229.17 debit, because in the year 4, we also notice a decrease in the amount of 229.17 from the amount in the year 3. So, also credit premium income $5,000, cash $4,500, and benefits expense $229.17. In year 5, we debit cash $4,000, which is equal to the expected premium, and also in the situation that the gross premium decreased to $4,000 in year 5. Then our benefits expense is equal to $4,500, which is equal to the actual amount paid. And our reserve liability is debited at the amount of 1,083.33 in order to reflect the true balance in the year 5, the true zero balance in the year 5. Then credit premium income $4,000, cash $4,500 credit, and benefits expense credit $1,083.33. Now that we are presented with the table, in the situation that both A and B happens, we have our expected expenses in year 1, $3,000, in year 2, $4,000, in year 3, $4,500, in year 4, $4,500, and in year 5, $6,000. Our expected gross premiums for year 1 is equal to $5,000, and that is true until year 4, and then we have $4,000 expected gross premium in year 5. To calculate our net premium, we first have to get the net premium ratio, which is computed using the total PV of expected expenses divided by total PV of expected gross premiums. The total PV of our expected expenses is equal to 22,000, while the total PV of expected gross premiums is equal to 24,000. So 22,000 divided by 24,000 is equal to 91.67%. And we multiply that net premium ratio to our expected gross premiums in order to arrive to our net premiums. So 91.67% times 5,000 expected gross premiums from year 1 to year 4 is equal to a net premium of 4,583.33 from year 1 to year 4. Now to our year 5, which is 4,000 expected gross premium times the net premium ratio of 91.67%, we now arrive at a net premium of 3,666.67. Now that we have our expected expenses, expected gross premiums, and net premiums, we can now compute for our reserve liability. So our reserve liability for year 1 is equal to 4,000 plus 4,500 plus 4,500 plus 6,000, which are the expected expenses in year 2 to 5, which is equal to 19,000, less than the total of the net premiums from year 2 to 5, which is equal to 17,416.66. We now subtract the two and we arrive at the amount of 1,583.84, which is our reserve liability for year 1. In year 2, our expected expenses from year 3 to 5 is equal to 15,000, less than the net premiums from year 3 to 5 in the amount of 12,833.33, and we arrive at the amount of 2,166.67. Comparing the past 2 years, we now observe that the reserve liability in year 2 increased in the amount of 583.33 from the previous year. So our year 3 reserve liability is computed by having the sum of the expected expenses in year 4 and 5, which is equal to 10,500 less than the net premiums in the year 4 and 5, which is equal to 8,250. We now subtract the two and we arrive at the 2,250 reserve liability. Now comparing the reserve liability in the year 3 and year 2, we now observe that there's also an increase in the amount of $83.33. Now our year 4 reserve liability is equal to 6,000, the expected expense in year 5, less than the net premium in year 5, which is equal to 3,666.67. Subtracting the two, we arrive at the amount of 2,333.33. Comparing the reserve liability in year 4 and 3, we also observe that there's been an increase in the amount of $83.33. And now that we're done with our table, we can now proceed to our journal entries. Journal entries for year 1, if both A and B happens simultaneously: debit cash 5,000 and debit benefits expense 4,583.34. The benefits expense is equal to the expected expense plus the reserve liability, and credit premium income 5,000, credit cash 3,000, and credit reserve liability 1,583.34. In year 2, we debit cash 5,000 and debit 4,583.33 as benefit expense. This is the total of our expected expenses plus the increase in our reserve liability. We credit premium income 5,000, we credit cash 4,000, and we credit the increase in our reserve liability, which is in the amount of $583.33. In year 3, we debit cash 5,000, debit benefits expense 4,583.33, which is equal to our expected expenses plus the increase in our reserve liability. We credit premium income 5,000, cash 4,500, and still the increase in our reserve liability in the amount of $83.33. Finally, we account for our journal entries in year 5, where we debit cash 4,000 because this is when the gross premium was expected to decrease in 4,000. Then benefit expense 6,000 when the expected expenses was increased to 6,000. Then we debit reserve liability 2,333.33. We credit premium income 4,000, cash 6,000, and credit benefits expense 2,333.33. We debited the reserve liability in order to reflect the zero balance of the reserve liability account in year 5.
So, for question number 4, Markopolos' allegation against General Electric warrants serious consideration. These claims expose critical issues that could significantly impact GE's financial stability and transparency. So first, let's break down the allegations into 3 key areas, namely the under-provisioning of statutory long-term care or LTC reserves by 18.5 billion. Number 2, a 10.5 billion increase in GAAP LTC reserves mandated by the new Financial Accounting Standards Board regulations. And number 3, the unrecognized 9.1 billion non-cash loss related to GE's stake in Baker Hughes. So, of course, each allegation, if proven, highlights a deficiency in GE's financial reporting with substantial implications, including reduced equity, strained cash flows, and potential regulatory scrutiny. Let's dive deep on Markopolos' allegations against GE's financial reporting. So first, the under-provisioning of statutory LTC reserves. According to Harry Markopolo, the GE underestimated its statutory LTC reserves by 18.5 billion, posing a significant threat to the company's financial stability. According to Markopolo, he analyzed statutory filings from 7 insurance companies covering 95% of GE's LTC business. Findings revealed inconsistencies in GE's reserves compared to industry standards, highlighting the 18.5 billion shortfall, which includes the 9.5 billion from benchmarking against other LTC insurers, a 5.4 billion as a risk premium for reinsurance uncertainties, and lastly, a 3.6 billion in premium shortfalls. Markopolos also pointed out aggressive actuarial assumptions and a lack of transparency in GE's reserve calculations. So of course, these allegations would have if proven true, would have an impact on GE's financial statements, including the adjusting for the reduced net income and shareholders' equity, lower earnings forecast and eroding investor confidence, and lastly, constrained cash flows, limiting funds for investments and growth initiatives. So overall, this adjustment would adversely affect GE's long-term recovery and profitability. So, the next on the list is FASB mandated increase in GAAP LTC reserves. So Markopolos asserted that the new FASB regulations effective January 2021 required GE to increase its GAAP LTC reserves by 10.5 billion, exacerbating its financial challenges. The new rule aligns GAAP reserves with statutory reserves, which are already higher, adding further strain to GE's financial health. GE had previously committed to increasing statutory reserves by 15 billion as of January 2018. This additional 10.5 billion adjustment under FASB would impose a significant pre-tax charge on GE's financial statements, reducing its profitability. Markopolos emphasized that this alignment not only impacts accounting practices but also poses liquidity challenges for GE, further straining its financial stability and operational capacity. The reserve increase would impose a considerable pre-tax charge, significantly reducing net income and profitability. It would deteriorate key financial metrics like the debt-to-equity ratio, raising alarm among creditors and investors. And additionally, diminished cash reserves could potentially hinder GE's ability to reinvest in core operations, undermining its competitive market and long-term growth prospects. So for the third allegation regarding the unrecognized non-cash loss on Baker Hughes, Markopolos accused GE of failing to recognize a 9.1 billion loss related to its 62.5% stake in Baker Hughes, further compounding its financial challenges. The report alleged improper classification of the Baker Hughes investment, avoiding recognition of significant losses. A 9.1 billion loss should have been reported as an investment-related write-down, significantly impacting reported equity. This misclassification not only obscured underperformance in GE's industrial businesses, but also misled stakeholders about cash flow and overall financial liability. The failure to recognize this loss inflated shareholders' equity, creating a misleading financial picture. Correcting this misstep would substantially reduce equity, increase the debt-to-equity ratio, and potentially breach debt covenants. And furthermore, the oversight could invite regulatory scrutiny and legal liabilities, exacerbating GE's financial instability and damaging its reputations. Together, the issues highlighted in sections 2 and 3 underscore severe strains on GE's financial health, signaling a pressing need for corrective measures to restore investor confidence and ensure compliance with regulatory standards. Lastly, the combined impact of these allegations paints a troubling picture of GE's financial stability, with repercussions spanning across multiple dimensions including liabilities and equity, market and investor confidence, operational challenges, and of course, regulatory and legal risk. Markopolos' allegations, if substantiated, underscore serious deficiencies in GE's financial reporting, and addressing these claims is crucial to safeguarding GE's financial integrity and restoring stakeholder trust. The cumulative impact on equity, cash flow, and regulatory scrutiny necessitates rigorous investigation and, of course, corrective action.
Why do you think the market reacted so strongly to Markopolos' allegations, and how do you assess GE's response to Markopolos' allegations? So the strong reaction of the market to Markopolos' allegation may be attributed to the following factors. The first being the company's history. So after reading much of the company's background, we learned that GE had several write-downs on its accounts and experienced decline in its stock price. So his history of financial difficulties raised a lot of questions and concerns and made the company more vulnerable to negative news. After that, we also believe that the nature and seriousness of the allegation may have contributed a lot in the growing concerns of the investors. After all, Markopolos' claims are extremely serious, and that alone raises a lot of concerns about the company's financial difficulties and profitability. He stated in his statement that GE was hiding 38.1 billion in losses and unrecognized liabilities, which if proven true could have a devastating impact on the company's market share and its reputation. The third factor is the reputation of the accuser, Markopolos. So he was well known for his past achievement when he exposed Bernie Madoff of his well-executed fraud and scheme, and this achievement resulted in his influence in the financial world. Hence, even if his allegations were as unsubstantiated, they are likely to be taken seriously by the investors. So next is the investor sentiment. So as we all know, the market, particularly the investors, react strongly to negative news regarding large corporations. So this is because it involves a lot of money and investments. Therefore, if the investors believe that these allegations could be proven true, panic selling may ensue and many may withdraw from their investment. So lastly, the investors may fear that GE could face significant legal and regulatory actions, including fines, penalties, and even criminal charges. So Chief Executive Lawrence Culp has strongly denied Markopolos' allegation, calling them meritless, misguided, and self-serving speculations. The company has stated that it operates with the highest levels of integrity and that its financial reporting is accurate. He also accused Henry Markopolos of false statement of fact and noted that he did not check his facts with GE before publishing his allegations against the company. However, despite GE's efforts, their response may not be sufficient to fully address investors' concerns. After all, the credibility of the accuser holds significant weight, especially when his past achievements are widely recognized. To sum it all up, Henry Markopolos accused General Electric of accounting fraud, alleging the company deliberately concealed a significant portion of its liabilities to inflate its earnings. His claims focused on General Electric's under-provisioning of statutory long-term care reserves, the need for a FASB-mandated increase in GAAP LTC reserves, and the unrecognized non-cash losses associated with its investment in Baker Hughes. The market responded strongly to these allegations due to GE's history of write-downs, unstable stock price, Markopolos' reputation, the gravity of the claims, investor sentiment, and regulatory risks. While there was insufficient evidence to substantiate Markopolos' accusations fully, his report raised valid concerns about GE's use of aggressive actuarial assumptions and lack of transparency in reserve calculation, suggesting potential issues in the company's financial reporting.